everybody. It's Tom Sheridan and Chris Darbyshire again, ready for the Q2 2015 quarterly asset allocation from 7IM. Chris, as we have been seeing for the last couple of years now, we have a continuation of the trip through the uncharted waters of QE. And first couple of months in 2015 didn't let us down. The surprise we've had this time, what happened to oil?
Yes, so the oil price declined very, very dramatically last year. There was a moment where I think the markets weren't really decided whether it was a good thing or a bad thing. And it sort of fed the deflation fears. But at the same time, we thought it would be very positive because we thought it would put money into consumers' pockets and enable demand, economic demand, to get back on course. That had really been missing from the recovery.
I'll give you a little plug. It was as early as last year where you said that the shift in commodity prices meant that we ought to be looking more at commodity consumers rather than commodity exporters. And in fact, that switch that you made to the portfolios last year has continued to pay off. Well done, Chris. In addition to the phenomenon of falling oil prices, plummeting oil prices really, we have maybe rate rises in the US?
Certainly rate rises are coming in the US, and the US economy is looking more and more normal, actually quite strong. What we also have around the world is a very strong trend towards reducing rates in other areas. So, of course, we've got QE in Europe. We still have QE in Japan. This is loosening monetary policy. And in Asia-Pac, that region, there's been a lot of rate reductions as well.
We had rate reductions in some of the Asian economies, as you said, but in Europe, we have negative interest rates in a couple of places. Another unprecedented event.
Yes, and they can't go any lower, really, in Europe. So that's when QE comes into its own and becomes an important policy tool.
So we have this very unusual circumstance, certainly one that I've never seen before, where banks don't seem to want cash anymore.
Absolutely. The banks really don't want to lend. The money that arrives in their balance sheets from QE sits there and really doesn't do anything. And that's really the regulatory pressure. So at the same time that QE is kind of giving banks money, banks then can't spend it because the regulatory rules are constraining them too much from using their capital in that kind of way.
And indeed, the expansion of the balance sheets is how we got into the mess in the first place, so you can't say that you blame the regulators. Now, oil, interest rates, China. China seems to be one of those larger-than-life questions for the markets. It seems to be slowing. It's gone from 10% to 7%. Now we're looking at 6s. What do you think is really going on there?
So I think it is a genuine slowdown, perhaps not quite as intentional as the government there would have you believe. But the critical argument there is the slowdown going to end in distress, or is it managed? Is the government capable of tweaking the economy enough just to keep things bouncing along on a positive trajectory? And we think that is the case. We think that what the government is doing there, which is clamping down a bit on certain industries, the sort of polluting heavy industries, but also then liberalising financial services, liberalising the access of foreign investors to Chinese markets. All of that seems to be balancing out, and we're getting, we think, quite a positive slowdown.
Well, the transition from an investment-led economy to a consumption-led economy, which is apparently what they're trying to pull off, was never going to be a short-term event. Certainly not if you're trying to do it for 1 billion people. Now, as we've seen the continued change, and this is only in 3 months, we very often try to look at what could go really wrong in the world, and then how do we position against that, and what could go really right in the world, and how do we position for that. Let's start with the downside risks. What worries you in terms of the left tail risks, if I could put it that way?
Yes, so the big left tail nasty risks out there is a US slowdown. So perhaps the oil industry slowing in the US, as we know why. Perhaps that combines with a strong dollar, which impacts US exports. So that kind of change of trend would be quite a significant tail risk. But we think it is a tail risk because it's certainly not in any one central scenario.
So in addition to that, I guess we also have the ever-present geopolitical risks. Right now, I would think that the Ukraine situation morphing into a U.S. versus Russia, I don't know if I want to say the word war, but confrontation. What do you think the probabilities are there?
It's very unpredictable. We're not sure how Putin will behave, given that Russia is going to have a very difficult economy this year. Last year its economy was actually poor but okay. This year it's just going to be poor. Negative growth. And so we haven't seen this kind of economic stress in Russia and whether that will undermine Putin's power.
Right. And again, we live with those geopolitical risks throughout the calendar. Deflation. We've had disinflation. We've had the oil price feed into the inflation or disinflationary numbers. We expect, the second half of this year, that the oil price becomes then a force for rising prices? Is that fair, or is it the third quarter?
I mean, mathematically, it drops out of the numbers in the second half of the year. So you should begin to see the headline inflation numbers. These are the numbers that include oil and housing and the more volatile components. They begin to bump up. And that's one of the things we've actually been looking towards with the portfolios. We think that will be perceived very favourably.
So the doom and gloom merchants predicting that the world is going to deflate, led by Europe probably this time. You don't agree?
No, we don't. It is one of the tail risks that you refer to, Tom, but we think that the trajectory of the economies around the world is generally positive. They're not quite moving as fast as we would like them to. Yep. It's not as strong a cycle as we would like, but we think that that is a bigger trend than the worries about disinflation and deflation.
Okay, so if we don't see the tail risk getting too fat at this point in time on the left, how about the so-called right tail risk, or what could go right in the world that would surprise us and give the portfolios a jolt from the other side?
So this has been a very real risk over the last couple of years. The right tail, those good scenarios that surprise everybody, are something we have to be prepared for, particularly as multi-asset investors. And our real fear here is that those people who believe deflation is the new normal find that their arguments are just no longer valid. And this could happen with the changes in the oil price in the data that we talked about year on year. So if inflation comes back in a positive way, at the same time that we have economic growth comes through, then the whole deflation fear might go away, and then you see kind of half the market who are concerned about deflation swing into being bullish again, and you've got then a melt up in equities and other risk assets.
We look forward to that one.
That's a nice problem to have.
Now, we seldom talk about performance in these broadcasts, but we've had a situation where over 3 months and over 1 year, 7IM has been top quartile in all of the different risk categories. First of all, congratulations and well done. We'll talk a little bit about the positioning that led to that performance and what it is that we're about to tweak based upon the asset allocation meeting that's just passed. Tactical views on equities, Chris.
So I think what we've done a good job over the last few years of being positive about equity markets, having an overweight, and then within equity markets we've chosen reasonably well, and in particular we've favoured Japan, which has had a good run up, and then more recently we've favoured emerging markets where we've had quite bullish markets in, say, India and China, for example. And then finally, earlier this year, we concentrated the portfolios much more in Europe.
So for those of you who are familiar with 7IM and what our normal asset allocations are, we have two very, very extreme views within the equity asset class, the UK and the US. In the UK, we have 6%, I think, and in the US is 4% in a balanced portfolio. 10% out of a combined 52% in equities. That's very, very large weightings to Asia and Europe.
Yes, absolutely right. I think normally portfolios would be very UK orientated for a UK investor, and the US being a very large stock market and a very successful performer over the last 5 or 6 years would typically be a large weighting as well.
So that's a very, very extreme view. A little word on why so much out of the UK?
We don't believe that the FTSE 100, which is our UK equity benchmark, is particularly appropriate for our investors. It's not really a UK benchmark in the sense that only a quarter of the revenues of those companies come from the UK economy. It's very biased towards certain sectors of the economy, such as banking, mining, energy companies take up a very big weight in the FTSE 100, and we're not sure we want those sectoral biases at the moment.
Right.
Time will come when they're attractive. And at the same time, the FTSE 100 is very concentrated in its biggest companies. So the 2 biggest companies in the FTSE 100 make up about 15% of that index's value. And again, we're not sure we want our investors invested so much in those companies at the moment.
Okay, and the reason for pulling out of the US is different, and as you've already said before, really because the currency rising is probably going to impact the earnings over there.
And valuations are pretty high in the US, and we thought those 2 factors together was a strong enough reason to underweight the US.
Now, it's important for our viewers and our investors to understand that when we had the asset allocation meeting, one of the questions that we posed was, is there anything to like in the world of investments other than equities? And that became a really hard question to answer. And yet when I look at a balanced portfolio, and we would normally have 36% in the fixed income asset class, you've somehow managed to maintain a 34% exposure. So keeping us within the level of risk that was prescribed by our rules that we set so that people understood what we were doing. In an environment where you don't like fixed income, what did you do?
So we have tended to underweight the so-called risk-free parts of the fixed income world, where we think that there is actually a chance they won't be risk-free at all in the next year or 2 and could be quite volatile. And we've overweighted the high yield and emerging market bond allocations, mainly because at this point in the economic cycle, we've got a pickup in economic growth in the developed world. So those high yield companies issuing normally debt that would be perceived as being pretty risky, well, they're less likely to default as the economy grows at a decent rate. And then, of course, as world trade picks up, and we hope it does, then emerging markets will begin to benefit from that. So that's why we have the emerging market bond overweight.
And the emerging markets historically have been subject to the ebbs and flows of international investor whims, really. They haven't exactly been flavor of the month recently. That's probably one of the reasons you like them, Mumsa.
Yes, I mean, it's been a disappointment to us that we have been quite overweight emerging market bonds. They haven't performed terribly well, but that's really coming from currencies. So it's coming from the impact of a very strong dollar driving those currencies down. And I think that's one of the risks we will put up with. It comes with the territory in emerging markets.
Yep.
And actually, we saw last year that emerging markets whose currencies weaken actually can rebound in terms of economic growth and aren't so seriously impacted.
Well, there's a clear picture on equities with the weightings toward Europe, Japan, and Asia. There's a clear picture with regard to fixed interest, the corporates, the high yield, and the emerging markets. The alternative asset classes in this environment, well, you've already said a number of times over the last couple of broadcasts that you really don't like commodities. How have you found a way to fill some of the allocations in the alternative space?
So just recently, actually, we've found a couple of interesting funds with alternative strategies. We had trouble doing this after the credit crunch. Performance had been lackluster among hedge funds, and we had concerned about the drain of fees if you're not generating a lot of return. We've now found a couple of strategies we like. One in the smart passive space, where we like to think we know what we're doing. And then also we found that our currency manager has been performing very well recently. Of course, there's volatility in currencies again. And so the managers can now make money in currencies again. So we're increasing the allocation there.
So is it fair to say then that the dominant alternative asset that we have in the portfolios is really the currencies.
I think it really is, and I think it's a very important asset because it not only produces return, but it manages the risk as well.
And they're very highly uncorrelated to equities and fixed, which indeed is the purpose of having the alternative asset classes, and that's why we call them alternative. Chris, that's a really, really clear positioning that we have in terms of equities, in terms of fixed, in terms of alternatives. Anything that you'd like to say in summary?
In summary, I think things are very positive out there at the moment. I think we've seen some strong trends in certain asset classes that may well correct a little bit, but I think we've got to keep focused on the bigger picture, which is the global economy is growing. The growth from the US is going to spill over into Japan, and Europe looks to be on a decent course as well.
And just before we sign off, we probably ought to say a word about the election in the UK and what impact, if any, you think that might have on our portfolios.
So it's a known that the election in the UK is very hard to call. My guess is that as we get closer and closer to election day, some of the voters who are threatening to vote SNP or UKIP maybe come back towards the mainstream, and the opinion polls then begin to reflect this, and that could be positive for sterling. So I'm not actually outright bearish on sterling or UK assets as we head towards the election. Let's not forget, the UK economy has got a very strong undercurrent of growth. It's weathered a bit of a downturn in the housing market, particularly in London, and it's weathering the uncertainty from the election pretty well. So I think that positive factor is going to trump election uncertainty.
So with the very strong underweights that we have in UK equities and UK fixed, the dominant impact of the election is likely to be the currency itself. Chris, once again, thank you for the great performance over the last couple of years and your thoughts today. We look forward to seeing you again in 3 months. Thank you.